Okay, y'all, we're still on opening trades, so let's get into some practical examples. Let's go over the topic of knowing your risk at entry and using probabilities and statistics to choose your risk and reward. So what I want to do right now, this is a trade that I currently have on, but what I want to do is show you all. I don't want to get into the finer nuances of this particular trade, but I do want to show you the probability that I will be profitable on this trade. So the way that I'm going to do that is I'm going to go to the options chain for Trade Desk, and I'm going to show you the probabilities of every option that I put on. So look, you're gonna have to use your memory a little bit. You may have to take a screenshot of this. So you see where it says I have two sold positions. Don't worry about the finer nuances of this trade just yet. Just know that I have two sold positions and I have two purchase positions. Now look at where the stock is trading at, and you will notice that it's which one out of these four. You see where it says the name of the position, and then it has 1, 2, 3, 4 options contracts included in it. Remember, don't worry, just know that this is considered one position. It has 1, 2, 3, 4 options contracts within that one position. Which of these four is closest to this? These are two puts, P and P, and these are two calls, C and C. Which calls of these two and which puts of these two is closest to this? I'll give you like 5 seconds. It's pretty easy though. 69 is closer than 68. 85 is closer than 86. Whichever one is closer, that's what your trade will essentially be. This is a sold trade, a credit trade. So when it comes to a credit trade, your position gains value over time, even if it doesn't quite move in the direction that you want it to. With a sold trade or a credit trade, you can make money if the stock moves in the direction that you want it to, or if it just sits still. That's pretty cool, right? So I want to show you some probabilities real quick. We're going to just use the 69 put and the 85 call. Show details. Let's go to options. You may have to turn this feature on that I'm using with the gear. So let's go to the gear. The main ones that we want to pay attention to is probability out of the money and probability in the money. If I sold something, probability out of the money is most important. If I buy something, probability in the money is most important. Don't forget that. If I sold something, I want it to be out of the money. I want it to be worthless, out, shunned, exiled, whatever you want to call it. But if I buy something, I want it to be in the in crowd. I want it to have friends. I want the option to be in the money within the stock. And in the money just means if you're on the call side, that means that the underlying price is above your strike price or your redeemable price. If it's a put, then that means that the stock price is trading below your put strike price. Okay, so let's get out of this menu and let's go to the ones that I chose. They're going to be highlighted here once we get to them. Boom. Remember we said we're going to look at the 68, and let's just scroll over to probability out of the money because this is sold. 71% chance. There's a 71% chance that I'm going to be profitable on this trade. My goal is at least a 30% return on my investment. And that's just one side of my trade. Look at the other. For the 85, there's a 77% chance that I'm going to be profitable on this trade. And so I'm using this to decide about how much of a return on my investment I want. I want at least a 30% return on my investment. I think that I have good odds with this trade. This is the reason I literally put these trades on. There's no emotion involved. It's just, okay, how much risk do I want to take? I want to put a hard number, a straight up solid number on how much risk I'm willing to take. Right now, I'm willing to take 100% minus 71. That's a 29% chance of failure. 28.64. That's probability in the money. It's a sold position. That's what I don't want. I'm wanting to win by this much. I like my odds of winning. 71% chance that I win on that side, and a 77% chance that I win on this side. And that's essentially it. I use this math that the market calculates for me. Granted, I have to set up my brokerage to show me these numbers. A lot of brokers, a lot of educators that I see, they don't talk about this. They just go immediately to the Greeks, and the Greeks can be helpful. They give you a roundabout as well. But there's nothing like looking at the actual probability that your trade will be in the money or out of the money at expiration. So remember, on the call side, if our trade is in the money, the stock price is trading above it. If it's a call and the stock is trading above it, it's in the money. So all of these that are highlighted blue are in the money. Everything else highlighted black is out of the money. Now let's go to the put side. It's when it's below our strike price. Okay, so everything that's blue on up, those are in the money. And everything that's black all the way down, these are out of the money. Of course, the further down you get, the further out of the money you get. In other words, the higher your chance of winning. And look, these have no bids, so these numbers will be, this is a great learning opportunity. I'm glad I looked at Trade Desk. Because there's no bids right here, guess what? These probabilities are gonna be wrong. There is no demand here. These are actually wrong. These probabilities are wrong. If you have a bid and an ask in there, though, it's going to be fairly accurate. All right, fairly accurate. These are far apart because this isn't an ultra liquid stock. It's not very liquid. It's sometimes hard to trade and hard to borrow. And actually, the Tastyworks desktop platform will show you when something is easy or hard to borrow. So that's another pretty cool feature about Tastyworks. But right now, we're still on Thinkorswim. But anyway, when you see no bids, that means that there's no potential buyers, at least not right now in the market. The market's closed right now, but still. I wonder if open interest, oh yeah, some people own some of these, but there's no bids right now. There wasn't no volume on a lot of these for the previous trading day. But essentially, the further up you get, the further away from the money you get, the higher the probability of your winner. So, but also, it's usually harder to borrow as well, depending on how high the volatility is. But look, if the volatility is super, super high, then some of these that are super far away from the money can still have some value. And that's why that's the first factor that I tell you guys to look up. Implied volatility, search for some volatility increases, or look up volatility in companies that you already know. If you already see that they have elevated volatility, then you can put yourself in a pretty good position with the high probability to win and still have some type of profit, some type of bid and ask. And right now I'm talking about selling stuff. It's important to sell when volatility is elevated. Okay. This video is long enough, so I will end it there. And I hope this helps somebody.